Koller Lange, what year did you graduate?
2020.
2020. So not too long ago. He's going to tell us all about investment banking, everything he's been doing since then, and questions along the way. As you go free to ask, so right up afterwards, and we're just moving right along. A couple more weeks left this semester, a couple more guest speakers, and so anyway, so far so good. Keep up the good work. Keep on top of it. So, time yours, Koller.
Perfect. So yeah, throughout this, I'll be walking through investment banking, what I do, what investment banking is. Please ask questions. It's going to make it a lot easier for me. So ask a ton of questions. Happy to answer anything. I know, like anything, right? We want to know about pay. We want to know about hours, anything like that. Please ask those questions. I'm an open book today. Okay, so does anyone, I guess I'll start out. Does anyone know what investment banking is? No one? What is it?
Leading companies through big transactions and IPO processes.
Exactly. Yep. We pretty much help companies sell or buy, right? That's like the basics of what it is. So where does that sit? Like when I say I work in an investment bank, like what does that mean, right? So I'm gonna use a pointer. So you can see this is JP Morgan, okay? So this is JP Morgan. Within JP Morgan, you're gonna have your consumer banking. So on the corners of the road, you're gonna see Chase Bank, right? That's the consumer part, okay? And then you have the mortgage where you have to go and get a house loan or something like that. That's the mortgage part, right? And then you have the credit cards where you can get credit cards and things like that, right? And then in the middle, you have this banking part, right? Investment banking. That is where I sit, okay? So I don't do anything with credit cards. I don't do anything with bank accounts. So my grandma, my mom always call me and they're like, oh, well, you guys are lending those credit cards out like crazy. Yeah, I do nothing with that, right? So I know nothing about credit cards, mortgages, not involved at all, okay? There's actually a huge separation, right? From here to here, I can't talk to anyone on this part, right? And same thing from here, right? So then after the banking, you have fixed income, equity. So that's the traders, right? Wall Street traders, okay? And then from there, you have more like the commercial middle market and then global asset management, right? But banking is special because we can't actually talk to anyone that does trades because we're working with public companies. We also can't talk with consumers or credit cards or retail banks because we're obviously working with them as well. So we're kind of in our own little category and do our own little thing. It's a little separate. And that's probably why a lot of you haven't heard of it before, because you don't deal with it on a day-to-day basis. People will never go into an investment bank and sit down and talk to someone unless you're a huge CEO of a Fortune 500 company. So like we said, is why does investment banking happen? Well, there's two main parts. There's sell side and buy side. So first I'm going to talk about the sell side. That's where I primarily sit. That could be a company needs liquidity. So they need to sell their business. And let's say, one example we see a lot is, let's say there's an owner that designed a new app. This owner has grown the company. It's now worth 500 million, but he has no money because it's all tied up in the company. Well, he would need to sell the equity portion to get that money. So he wants liquidity, right? So that's one thing. We'd come in, so he would hire an investment bank. We'd come in, we'd do valuation. We'd go find someone to buy it. And then when someone bought the bank or the company, he would then get money. He or she would then get money. Underperformance, let's say you suck, right? You started this company, you just really suck at it. And you need to sell it to someone. Well, we'll come in, help value it and sell it to someone. So someone that's better can take over and run it. You want to grow. This is interesting, okay? Let's say you are one example is a dental company, okay? You want to become a giant dental company. You bought 5 locations, but to buy 5 locations, it took you 5 years. You don't want to spend another 5 years growing to 5 locations. You want to grow faster. You want to do 10 next year. Well, to grow to 10 locations, you need a lot of money. You need millions and millions and millions of dollars, which you don't have. So you'll need to sell a portion of your company to someone who has that money to help you grow, right? So you form a partnership. You say, hey, I don't have the capital to grow. So would you buy 50% of my company because you have a lot of money and then we can grow together and we can both make a ton of money. So that's another reason why people sell and they go through sell side transaction. And then distress and all these other, sometimes they just receive a random offer, right? Someone just comes, approaches you and says, hey, I want to buy your company. And then you say, okay, well, I'll entertain that. Let me go hire an investment bank to value me and make sure I'm not getting screwed in this deal. Buy side, the other way. So just like people sell their businesses, people always want to buy businesses. So just flip the side. Okay. So sometimes you want to buy a business because you recognize it's below the intrinsic value. It's currently trading at less than what it's actually worth. Right. So that's a big reason why you want to come in. You're like, oh, I'm going to buy that. Warren Buffett does a lot of that stuff. You'll find businesses that are undervalued. He'll go hire an investment bank and then he goes and buys them. Right. You maybe want to grow yourself. You say, hey, I want to grow. I want to become bigger. Then you're going to hire an investment bank to help you grow and develop. Economies of scale. So when you're a dental company, let's say you're already a big dental company and you have 100 locations. Okay. When you add another location, okay, so you start your 101st location, it's not going to cost you that much money because you already have the supplies. You already have the equipment. You already have doctors. So it's really easy to start that new location and you get economies of scale with that. So that's another reason that people buy a lot. Okay. Economies of scale, IP. This is a lot in tech space, right? You'll just hear like the algorithms. Sometimes people just want to buy algorithms. So they'll hire an investment bank to value how much that algorithm actually is worth. And then you go out and buy it. Okay. So those are the two ways that banks work and operate, right? We usually do sell side or buy side. There's tons of other different reasons why people will buy or why people will sell. These are just a couple examples. Okay. So does that make sense? Does anyone have questions on that? Now, do you guys understand? So when I say investment banking, it's not mortgages, it's not credit cards, it's working with big banks, or sorry, working with big companies, right? You're the investment bank. Everyone makes sense? Yes.
So how would you go about evaluating an algorithm? Like I know that's becoming more prevalent with
Yeah.
AI. Like, how do you kind of put a dollar on that?
Yeah. So there's different ways of doing that, right? So I don't specifically work with IP technology and stuff like that, but there'll be teams dedicated to that. And what they'll do is they'll usually do it from like the market value, right? So they'll say, okay, this is how many people are using the app. This is how much it generates. And they'll build up a forecast model from there, discount all the cash flow back to present value and say, okay, this is what I would pay for it. They'd also take precedent transactions and they'd say, oh, other tech companies or IP sold for this much. If we average all of those out, you're in this range. And then you'd go and sit down in a big table and you guys would just negotiate. How much do you want to buy it for? Do you think it's worth this? And that's kind of how it comes down to it. But you do a few valuation techniques beforehand, right? And those vary by each industry. And I'll get to that a little bit later.
Exclusively sell side, or do you do anything on the buy side?
I do some stuff on buy side. Yeah, I do really small things on buy side. So I usually sell companies that are around 10 million to 30 billion on the buy side.
Okay.
On the sell side, I usually sell from 50 to $1 billion. Okay. So that's it. But yeah. When most bigger banks, when you start in bigger banks, actually, we'll just go to that. Let's talk about that. So now there's different types of banks. Okay. So you have bulge bracket banks, which are the names you've heard, right? JP Morgan, Goldman Sachs. And oh, another thing I forgot to tell you guys. These slides are full of a lot of text. Don't try to read them. I'll send all this to you afterwards. I just love to put a lot of text on. So I know you're marketing.
You're an investment banker. You like slides.
Yes, I love
You
slides.
slide deck, like
I
a pitch
love
deck.
it.
Oh, great.
Yes, this is fantastic. So this is fun to build. But yeah, so don't try to read all this. We'll send it to you afterwards and you guys can read through all of it and learn more. But you have these different banks. And so bulge bracket, that really refers to this third bullet, which means on balance sheet. So when you hear bulge bracket, it means that the bank actually has a balance sheet. So when they're doing a buy side transaction, they can lend their own money. So let's say someone's trying to buy a company and they go, oh, I will give you some of my own money to help you close this deal and make sure it gets done. Right. So that's kind of why we categorize them as bulge bracket. These are all the big banks. And then you have elite boutiques. Elite boutiques do not have a balance sheet. So they're going to solely be focused on M&A or IPOs or something of that sort. Right. They have a specific focus and that's all they do, right? These are names you haven't heard, but if you're involved in investment banking, they're usually what all the students want to get to, because we'll talk about the pay later, and that's usually really, really good in boutiques. Then you have middle market banks. They're just kind of, they're very similar to bulge brackets, but they tend to work on smaller transactions, usually 150 million to 500 million, is kind of where they play. And then you have lower middle markets. I work at Logan Growth Advisors, and we play between 1 million, 150 million, and that kind of range, obviously. So these kind of get blurred, this line right here. Sometimes lower middle market companies play up, sometimes middle market companies play down. It all depends. But that's kind of how the breakdown of the market is. Does that make sense on the different types of investment banks there are? Most people get excited about these. These are the really fun ones, because these are the ones that are on the Wall Street Journal front page, and they're always really exciting and big. Most of my interns have all left, and now they're working. I actually have 3 of them working at Barclays. And when Meta did their big bond offering, that's a transaction they got to work on. So it was really fun for them to go get the Wall Street Journal and hang it up on their wall and be like, I worked on that. I did all of that. So it's cool stuff. Now, within a bank, there's different roles and responsibilities. Like we're talking specifically within investment banking, right? So you have the front office, and this is a bulge bracket. So let's say like JP Morgan, right? So you have the front office of JP Morgan, you have sales and trading. They're going to be trading equities, fixed income, and then you have the investment banking division. You have middle market, risk management, back office compliance, obviously making sure the front office isn't doing anything illegal, breaking laws, doing anything like that. Insider trading, that's where risk management compliance really comes in. And then they also have to, like, there has to be someone that does your books, right? You still have to file taxes. So that's why you have like accounting, IT, you have to have Zoom accounts and human resources, you have to hire people. But we're this mainly focused right here. So this is where I would work. I would work in the front office, revenue driving, investment banking group. Okay. So that's kind of the breakdown of different offers. So you can still work at Goldman Sachs, but maybe you're in the risk department, or maybe you work at Goldman Sachs in investment banking, compliance, accounting. There's all these different roles, and I assume we probably have someone from come talk about the different roles. Okay. So let's talk about industry group. So when you start investment banking, this goes back to your question about how do you evaluate. I specifically sit on a coverage group or a product group. So I only do M&A. So I only do mergers and acquisitions. That's all I focus on. That can be buy side and sell side, but I just do models for any industry. So if it's healthcare, I'll model it. If it's technology, I'll model it. Now, my bank is more focused on healthcare, so I tend to do a little bit more healthcare deals. However, I've seen we just recently closed on an aquarium. We've also done real estate in Texas. We've done dental offices. We've done hospitals, all these things. So I just mainly do modeling for anything that's an M&A transaction. You can also do debt, capital markets, where you're only doing debt. You can do leveraged finance, where you're just working on leveraged finance. You can do RX, where you're just doing restructuring, things like that. So that's what a product group is. And most banks take if they're product or industry. If you're product, you're going to get stuck in doing one thing where it's like, hey, you just work on M&A deals. While if you're industry, that is when you're stuck on a specific industry. So you can say, oh, for example, I believe Goldman Sachs, they do industry groups. So when you get an offer from Goldman Sachs, they'll say, okay, you're going to work in Goldman Sachs investment banking division in their TMT group. So you'll only do tech deals. That's all you'll do. Or you'll say, oh, you're in Goldman Sachs healthcare group. You will only do healthcare deals. You'll do all the parts of the healthcare deal. Well, M&A, I'm only focused on the modeling, evaluation of the process, right? I don't do a lot of the closing. I don't do other things. I just do the M&A part. While with industry, you're doing start to finish. You're doing every aspect of it because you specialize in healthcare. Does that make sense? That's the best way to think about it. Okay. And again, as all of finance, it always depends. A lot of things roll over to each other. And sometimes you can work in a healthcare group and work only on M&A transactions for a year. So it depends, but generally you're going to see these two breakdowns between industry and product group. Anyone have questions on that? Does that make sense? Okay, great. Awesome. Now we're going to get to the hierarchy. Okay. So how, like, kind of, hopefully I've explained enough, like what an investment bank does, kind of where you kind of, what you do in an investment bank, how it operates. So now let's talk more about like what you would experience, right? If just coming out of undergrad, what would be your role? Well, your role would be an analyst, okay? So an analyst, and great thing, what I've really loved about investment banking is they have structured promotion. So you start analyst, and when you start, you immediately know how long you'll be an analyst. When you're an associate, you know how long it will be. And everything's very categorized, even down to your pay. And the great thing about investment banking is everyone, it's kind of like public knowledge, everyone talks about it. So your pay is very standard. You know what you're going to get paid at what bank, you know when the bonuses come, you know how long you'll be there until you get promoted. It's very structured. So there's a lot of structure around that, which I found really interesting because not a lot of other, or at least I would say not a lot of other corporate jobs have this much structure where you're like, I know exactly, I know the big four does, but other like operation roles don't have this much structure around it, which I've really enjoyed. So you come out and you're an analyst. When you're an analyst, like I said, you're going to be doing a lot of modeling if you're on the M&A team. If you're on an industry group, you're probably going to do a lot more pitch books. You're going to be building a lot of decks out. So that's a lot of PowerPoint work. When I was in undergrad, I thought I would be modeling day in and day out. I was so excited about that. And then for the first 2 months, I just built decks and I thought I was doing something wrong or I was in trouble. But I just realized that's how the kind of industry works. It's a lot more pitching. It's a lot more building decks. It's how do you present this company? All right. And then afterwards, I was lucky enough to get on a new deal that was heavily modeling, and I spent a year working on one model. I think it was version 326 before we finished that. So you do get a lot of reps building out models and understanding them. And that's a great thing about your analyst years. Is your analyst years, we'll talk about hours later, but they're definitely, I guess we can talk about it now. As an analyst, you're usually working between 60 to 100 hours. Now that seems like a big range. I would say the average is probably more like 70. It's on the lower end. I was really nervous going in. I was hearing, oh, there's 100-hour weeks. It's going to be constant 100-hour weeks. I found that's not to be true of true work. So how my day works as an analyst, or how it was when I was an analyst, was I would usually get into the office around 9 or 9:30, and then I'd catch up on my emails until about 11. Then at 11, I would usually go out, hang out with some friends, get something to eat, walk around, and then I'd be back at the desk in about an hour. Then I would sit down and I would work, probably take a couple client meetings. 4 o'clock, 5 o'clock would roll around, and usually I would go down to the gym for an hour or something like that. After that, I would come back to the desk, and at that time, my seniors, so the associates and VPs, were all done with their client meetings, and so they had all these requests from the client from that day. That's when they would dump all the requests on me, and I'd have to get them done by the next day. So then I would usually start working pretty hard from 6 to 8, and then at 8 o'clock, I would go home, get some food, or I'd go out to eat. If I had to stay at the office, I'd go out to eat, come back around 9, and then I'd work from 9 until whenever the work was done. Okay. So as you can see, it is long hours, but it's not constant work. And I think that was what really confused me, is I thought it would be constant work. Like I'd be sweating over a model all day and I could never leave. And I found that not to be true. I actually have a lot of flexibility. And another cool thing about banking is I always thought I wanted to be like an entrepreneur and I wanted to go run my own business, but I was always a little scared of the risk, right? I was like, how would I make money? I just don't know enough. Investment banking, I found to be a very good happy medium where I could show up one day at 11 and no one would say anything. My boss wouldn't care. No one cared. No one batted an eye that I showed up at 11. I didn't have to tell them I was going to show up late. The expectations, you get your work done. So it gives you a ton of flexibility. So if you have something at noon, or you want to go get your hair cut or go out or eat lunch, you can leave and you can take an hour and a half lunch. There's no set times, where in a lot of other jobs, you had to show up by this time, you have to stay in it for this long or something of that sort. Investment banking, people put a lot of trust on you and they just expect you to get your work done. Right now, if you don't get your work done, that's a whole nother issue that you don't want to have happen, but that's kind of the expectation. So when you hear those 100 hours, I probably could say maybe I was at the office 100 hours. However, some of those were probably me just sitting at the desk, talking to someone, going to get food. There's a lot of other breaks in between that make it a little bit more manageable than what I originally thought. Now that doesn't say there are some weeks, right? We had a big deal about 6 months ago. We had about 2 months to get it done. The client wanted to close in 2 months, which is a really tight deadline, a really, really tight deadline. For about 2 weeks, it was very, very busy. And that's usually, I was in at 8, I was going home at 2, I was coming in at 8, going home at 2, 6 days a week. So it does happen. But as soon as that project ended, I got off at 5 the next week, right? It was super easy week the following week. And it wasn't bad at all, showing up at 9:30, 10, getting off at 5. It was really great. So there's this big balance, right? And I just want people to notice that they'll see the 100 hours and they'll be so scared. And, you know, there are times like that, but there are also really slow times as well. Right now in the industry, it's just a slow time. There's a lot of concerns, recession fears. So it's just slow. M&A isn't happening. Transactions aren't happening right now. So that's kind of a day in and day out life as an analyst. Any questions on that? Happy to talk more about my day to day. Yeah.
Did you mainly get most of like your building model reps like on the job, or you just kind of already have the
On the job. Yeah, they do a great job of training. Before you start, you'll go through about a month of model training with the bank. They'll buy really nice courses, and they usually fly in trainers, and you'll do like a 3-day course with the trainer, and they'll teach you everything. And the great thing is, yeah, that was another thing, is I always thought I needed a model in undergrad. And so I was like trying to practice modeling, and I learned it, you know, just model templates, like what you do in those courses and the real world are very different. Now, if you understand them, like, and I think school just teaches you a great like understanding of them, right? If you can understand all the different components of it, it helps you out a ton. But no, you don't need to know how to build a model out from scratch. You just need to have like a good understanding of how things work. Does that make sense? Does that answer your question? So yeah. Yeah.
So are you still in the analyst role?
No, I am not. I'm in a little bit of a weird spot. I would say I'm somewhere between an associate and a VP right now.
So when you move up, have your hours decreased to your amount?
Yes, because as you move up, you get analysts underneath you who can then support you with the work. So then during the day, you're working with clients or working on live deals, gathering information. And then you're like, oh, I need this model done. I'm going to send it to my analyst to take care of it so I can push on other things, right? And so you get a lot more support. Now the hours can still be as bad, but it's not as bad. You definitely, and then higher up, when you're VP, it's really nice. Then obviously when you're a managing director, you get to come and go as you please, because you've done so many years that you've built so much trust.
Travel? How much you traveling as an analyst versus an associate?
Analysts, not much at all. So you'll have like consultants, they travel a lot. If you like travel, do consulting. Banking, you're really stuck on it. There's almost no travel your first 2 years. Ever so often you might have to do a site visit, or if they're low staff on associates, once the associate was out, so I got to go fly out and be at a deal closing and on site visit, and that was really fun and cool my first year, but it didn't happen often. Higher up you go, more travel there is. And so that's a little bit why you get more flexible schedule. But no, I would say really, if you're an analyst, especially in New York, plan on just kind of staying in New York. It's a life for people who want to stay put. There's not a lot of travel, ever so often, maybe once or twice a quarter, but nothing more than that. And that was huge for me. I was married coming out of undergrad, and so I didn't want to be away from my wife, even though I didn't get to see her a ton my first year. I didn't want to be away from her and traveling, and so that was something that I really liked. Is I didn't have to do that much travel as a first year. So I like that. Yeah.
So it looks like the position, it's pretty quick, yeah, like managing director. So what age would you say people typically retire? Is it pretty younger than other fields?
Yeah. Like you can make, so the earliest I've seen is probably 10 years managing director. So that puts someone at the age around like 30, 32, around there. give or take, right? That's usually where they're managing director. That's like the youngest. And at that time, you're making quite a bit of money. And so I think at that time, you could retire if you wanted. So early 30s, mid 30s, you could probably retire. But you don't see a lot of it. I want to make that clear. You don't see a lot of that. I'm going to say probably 70% of analysts leave after their 2 years. So after you do your 2 years, you leave investment banking. Very few people stay in. I want to say I have probably like a good close group of probably like 10 friends that all went into banking together. And me and one other are the only two that stayed. Everyone else has left. So it's very, very common to just do your analyst years and get your reps building the models, get your reps working on the PowerPoint decks, getting that experience, get a couple weeks working long hours. Like that's a great training. And then you take those skills and you go elsewhere. And there's a ton of opportunities. You heard one last week, Greg, who's working in private equity. It's a huge exit opportunity. You kind of learn the basics here, and then you go into private equity where there's a lot more work-life balance. They get to do different skill sets, right? No longer are you just transaction-based, right? In investment banking, I'm just transaction-based, right? I take no risk, right? I sell the company, and when the company sells, it's like, oh, it's sold, that's done. I don't care if it operates or not. Like you do kind of care, right? So you don't want the valuation to be way off. You don't want to mess it up. But I don't have any money. I don't have any skin in the game, right? Well, private equity does have skin in the game. So that's a whole different set of skills. You have to know how to operate, grow, and manage people differently than what you learn in investment banking. So that's why you see a lot of people get this skill set of transaction, understanding the ins and outs, and then they take that, they go learn how to operate, put some skin in the game, really refine their skill set in private equity, and then they can go do whatever they want.
So what made you stay?
I really like my firm.
Yeah.
Yep, I have a great firm. I'm kind of in a different position than most other bankers. I started at Loan Growth, and at the time there was only 3 people, and I was employee number 4. I believe we have around 70 employees now. So it was really fun to see that growth and be with that. But yeah. Yes, sorry.
So you said that you're talking about the analysts, how after about 2 years, normally they leave.
Yep.
Is that something that when firms are hiring, they expect that to kind of happen?
Yeah, they know what's going to happen. They don't want it, so don't tell them you're going to leave, right? Because I think I just kind of like salt in the wound. But yeah, then everyone knows it's going to happen. Everyone's pretty aware of it. And like I said, with so much structure, it's funny. There's actually structured recruiting process to leave banking. So I'll touch on that a little bit. I'm not sure if Greg did. But analysts who start within the first month of starting as an analyst. So I'm saying you just graduated, it's June, you start in New York City. Within that first month, you'll be interviewing for private equity positions for 2 years. So you essentially start, interview, and then know, oh, in 2 years, I'm going to leave. So that's usually the traditional on-cycle route is what it calls. So, and some people are now even doing it earlier. I know Tower Arch, they do a early cycle, and a lot of other firms, like a lot of other lower middle market, Utah based, there's a lot in Tampa that do very similar things where you'll be a senior going into banking and they'll interview your senior year. That's very common nowadays. A lot of things like that, or a lot of private equity firms. Does that make sense? So yeah, they do. They know you're going to leave. They don't want you to, because it's always hard to train new people, but yeah, the expectations, a lot of them will leave. Okay, any questions on this? On the hierarchy? Cool. Now we get to go to everyone's favorite slide. Compensation slide. This is what people love. So let's talk about this a little bit. This is probably, bonuses are probably a little high here. I think we pulled this in 21. So I think we pulled these numbers in 2021, which was a boom. So these numbers are probably a little bit high. But yeah, we can walk through them. So average base is about 108. You can see that right here, bulge brackets across the board, they're between 100 and 110. I do think this has gone up. I think a couple bulge brackets raised to 120 base. And then you'll see elite boutiques are about 120 to 110. So elite boutiques definitely pay more than the bulge brackets do. That's usually because a lot of people want to go get the experience at Goldman Sachs, which is a great name. So they're actually willing to take a $10,000 pay cut to get the experience in the name, in their resume. And then you got middle market, and they pay a little bit less. But middle market works on smaller deals, they're not as big, so they usually get a little bit better work-life balance and things like that. Okay. Then bonus is usually around, so for your first year, you're probably making 110, and then a bonus around 80. And that can vary, right? If you're 120, your bonus might be, it ranges between 60 and 100% of your base. Because that's usually what you see as your bonus. And again, that's very structured. They will actually categorize you into bottom, middle, top bucket. And then like bottom bucket analysts will get like 60%. Middle bucket analysts will get 80% of their base, and then top bucket will get 100%. And if it's a great year, maybe it's 120%. But that's very structured as well. And you're rated and graded throughout your internship process and full time. And so usually coming out all in comp is around 200. That's usually get a $10,000 to $15,000 signing bonus as well for your first year. So you're usually breaking 200 your first year out of undergrad. Analyst 2 probably get around 210. And then associates, it's a huge jump into 300 plus, associate 2, 350, and then associate 3 is usually around 400, or that's when you become a VP and you're 400, 500 range. So within about 4 years, you should be around 500 plus a year out of undergrad. Any questions on that? Yeah.
So it's like AM, 1 AM, 2 AM, like your first year's analyst and second year's analyst.
Yeah, first year analyst, second year analyst, then first year associate, second year associate, and then if it's a third year associate or third year. Yeah, that's usually the pay there. Yeah.
Oh, that's really nice. You said it's slow,
Yeah.
Well, right. So how does the bonus get impacted by that?
Yeah, that's tough. That's a tough thing. The bank decides, right? The bank can always decide your percentage. So maybe your bonus was supposed to be 100K, right? 100%, you're making 100, so it's supposed to be 100%. But then the bank had a really bad year, or scandal happened, or whatever happened, and they have to cover it. Then they come in and say it's only going to be 50%. Right? And so that the bonuses is a variable amount, and in down years it's really down, and in up years it's really up. And you see that across the board. So in that's why these are probably a little inflated. I would say last year, most of the bonuses I was hearing for an analyst 1 was probably more like 60 to 70K. While in so that's 2022, and then 2021 was a great year. So everyone was more around 90 to 100K. And that's kind of what I saw across the board. Okay. All right, so that's a compensation. Now let's talk about, this is about the process you run, okay? So this is going to dive into a little bit more of like the day-to-day, and then I want to wrap up pretty soon. So, right, you pitch, you're making a pitch deck. This is we've talked about this. You're building out PowerPoints. You're pitching companies saying, oh, sell, you should sell. Here's why you should sell, and here's why you hire us, right? If they say, okay, you know what, you're right, I should sell, and I'm going to hire you to sell me, that's when you win the mandate, okay? Win the mandate, then as soon as you win the mandate, this is kind of where it gets really hard, right? This is where the 100 hours come in, right? You're not working 100 hours, but then once you win the mandate, it's like, all right, it's go time now. You have to build out a teaser, and you have to build out a sim. I'm going to send you guys examples of that after class. And then you guys can review those and just see what they look like. And then after that, you're going to build, confidential information memorandum. I think I have a slide about that. Confidential information memorandum. So what that is essentially, here's an example slide. Here's what it looks like. And so you're taking just industry metrics, you're taking specific practice metrics, right? So this company looks like it has like 12 million of revenue, 4.6 million of EBITDA. And you're just taking this company information and you're putting it on a slide that investors can read and understand, like, oh, is this a business I want to buy or not? And they can understand them. Okay. So then once you build the sim, I guess to build the sim, we can just go over this too. To build the sim, you have to do like financial modeling, right? So whether that's like an LBO, a DCF, maybe it's comps, precedent transactions, you can do all that, right? That's what you're doing. You just want a mandate, so now you have to go figure out, okay, what is the value of this? You're gonna do all these different valuation techniques to understand what that is. And then you take all that work you just did of DCF and LBO, different operating models. Maybe it's a merger model. You do all these different models, and then you put that information into the SIM in a nice and tidy chart, right? And you're like, all right, this is kind of what I came up with. Okay. And then from there, you're going to have to go out to the market, right? So you're going to go call different private equity funds, and you're going to say, hey, Bob at XYZ private equity fund, I have this deal. Do you want to look at it? And you're going to say yes or no. And then you call Susie from the next one. Oh, do you want to look at this? And they'll say yes or no, right? And then you get these people interested, and they'll look through and they'll say, oh, on the SIM, they'll say, oh, on the SIM, you say it's going to grow from 4.6 to 4.9, but revenue's staying flat. What's driving that? Why is that happening? And you'll have to answer those. And then you sit there and you answer all the investor questions, and you help them understand the business, what was your rationale behind the models, what were your assumptions, and things like that. Okay.
The analyst or the associate, or who's answering those questions, or did the?
It depends.
VP level?
Usually the VP's there, but you're answering them. The VP's conducting the meeting, but when there's a specific question, the VP usually is going to turn to the analyst and say, you built this model? How'd you do that? And that's when you have to answer. So you have to know your work, right? And that's a big part of the hours too, is just like learning. We talk about 100 hours. Like if, let's say if someone comes in and says, hey, look, I'm selling a vet practice for $1.2 billion. How many people in this room know everything and anything about vet? Probably very little. So you're going to have to spend a lot of time learning about vet and how to value it. What's the industry like? Things like that. So that's where a lot of the time goes, is just learning. And that's what I've loved about banking, is it feels like college. I'm just learning constantly. Great. So after that, they answer questions. They're like, okay, you know what? I'm interested. They're going to submit an indication of interest, an IOI. Once that happens, you give them more data. You're like, all right, you're interested enough to submit kind of an IOI. And so then we're going to open up a data room, and a data room is everything from employee contracts to your models to anything you can think of that has to go with a company, right? We give them access to everything, and everyone digs in and they're asking more questions, and we help answer those questions. And then maybe two groups at the very end say, you know what? I want this company. I want to buy it. And that's when they submit a non-binding LOI, what is a letter of intent. I want to buy this. You then take that letter of intent, you go to your client, and you say, okay, here are the two offers we got. There's pros and cons to both. What do you think? What do you like? What you don't like? And as an analyst, you probably get to review those for legal terms. What are the tails on it? Like there's tons of legal stuff you have to kind of learn and understand and work through. And so you're going to be working with like in-house counsel to understand those and reading through them all. So that's probably where a couple other hours come into play, where you're just reading documents and understanding how to view them. And then let's say the company picks, okay, we're going to go with this company, this private equity firm A, right? And then they sign the LOI. Then that's where you do confirmatory due diligence. You'll build out a QV, a quality of earnings. That's just essentially making sure the financials are right and accurate. So you'll do a quality of earnings. And usually you're going to hire one of these big four accounting firms. So you go hire a big four accounting firm, they come in, they help you. They'll get to what EBITDA is, and then you're done, right? And then confirmatory due diligence, and then hopefully you close and throw a big party and celebrate. It's probably the biggest part right there. But there is a lot that happens between confirmatory due diligence and close, right? Everything has to tie. Everything has to make sense. Investors want answers to everything. So there's a lot of learning in that process. Okay, does that make sense? So that's kind of where all the work comes. That's the process you run. And then once it closes, you start on the next one. You go back, you start pitching until you get your next deal.
Are you generally working on one at a time, multiple? How many would you have in your
2 to 3.
workflow? 2 to 3 at a time?
2 to 3. Your staff, you have your, so there's going to be a second-year analyst who's going to be called a staffer. And his or her responsibility is to make sure you're on enough deals and not too many deals. Right, so his or her role will be, oh, you're on these 2 deals. Let's make sure it's happening. These deals die all, excuse me, deals die all the time. So like as you're going, maybe you're only on 2 deals and then both die. You'll need to get staffed on the next 2 deals or something like that. I was really shocked how many deals actually die.
What would you say in terms of the rate? How many are dying? How many making it through the end of the process?
I would probably say 60% make it through, 40% die. 40% probably die. And that can vary. Usually on bigger banks, usually bigger banks, it's higher probability, but less of them. While lower banks, it's a lot more die, but there's more of them, right? If you're working at Goldman Sachs, you're probably going to take a whole year to get one deal done because it's a $8 billion deal or something. Okay. Yeah, so this is kind of the example. Company invites these banks to pitch. They all show up to their office wearing their fancy suits. They pitch the deck. I'm not going to pitch in PowerPoint. You make the pitch deck, and then at the end, the company decides who won the mandate. When you win the mandate, then you go off and you run the process. Make sense? Awesome. And then let's go here. Roles and responsibility. I kind of talked about this a little bit. Sim building is probably 60% of your time. Financial modeling is 20. Then data, just managing the data room, collecting information, learning about a new industry. That's 15. And then probably 5% is just like other tasks, like responding to HR or something like that. And then scholarships. So there's 2 scholarships that if you're interested in investment banking, you can apply to get. One is the IBPE VC scholarship application. And the other one is going to be the Lange Family Opportunity Scholarship. Both of them, the Lange Family is a $1,000 scholarship that helps you if you want to do any networking, buy any course, or if you just want to, I can't remember all the things, but I think it's networking or buy a course or take a class or something like that. Yeah, career exploration. Yeah, so that's what, then that gives you like $1,000 to do that. And then this one is 500 stipend for 2 semesters where you get other teaching training. So that's investment banking. What questions do you guys have?
I just like how to get into it, do some internships.
Yeah.
What years?
Yeah, so sooner better. You have to start out really early to get into investment banking. Usually investment banking recruiting kicks off your sophomore year. So if you're a sophomore in the spring, they're going to start recruiting for your junior summer. So usually they require about 2 internships prior to applying. So that's smaller freshman and sophomore internships. Some great ones are like Industry Pro, Vermilion Rock. I know Lift Capital. Those 3 of those do great internship opportunities for freshmen and sophomore. You do those, and then you also need to study technical questions just to know you understand finance. You usually do that through, there's a guide, I think Paul has it, or the Finance and Econ Club has it, but it's called the Breaking into Wall Street Technical Prep Guide. And that's a guide out there that everyone kind of uses, and you just kind of have to read through and understand the technical questions. Those are the steps to get into it. Does that make sense? Mm-hmm. Any other questions? Yeah.
What's the teamwork dynamic with like a group of analysts working on a project with it? Like, is it 10 people, is it you by yourself?
Yeah, no, it depends. Usually it's 1 or 2 analysts, and then an associate is kind of reviewing your work, and then you have a VP that's leading the deal. And so the VP will never be in the weeds, and they probably aren't looking at the models. It's the analyst building the model, the associate reviewing it, and then the VP presenting it. It's kind of the structure and hierarchy of it. So but that's usually it. 1 VP, an associate. And that obviously bigger it is. If it's like a huge deal, then they'll have a managing director or a director be involved, and maybe 3 or 4 analysts. But the first structure I said with 2, 1, 1 is usually what you see on normal deals. And it's always fun because you guys work in a bullpen, so you're all side by side. back to back in a little office. And that's really fun. That's really fun because everyone's in the thick of it. They're all learning. You get to turn around and ask people questions and stuff like that. It's a fun dynamic. Yeah.
Do you feel like you're over or undercompensated?
For like,
What you're doing right now?
I feel like it's pretty fair. I feel like it's a pretty fair compensation. The hours are tough and you have to, it's not one that has a lot of work you can just not think about. You're constantly thinking. So it can be difficult and hard. So I think it's a fair compensation. I do.
Do you feel like you were fairly compensated as well as the associate?
Yeah. As an analyst and an associate, I feel like the compensation is pretty fair. It's higher in investment banking than it is private equity. Right, so if you go to private equity, sometimes you'll take a little bit of a pay decrease to do that, but you get better work-life balance. So obviously I've sacrificed work-life balance for a higher compensation, and I think that's just, yeah. I'm not sure if the bank would say the same, but I sure think it's fair. Oh, yeah,
You said you graduated in, I think,
yes.
did you do an MBA or did you go just from another job?
Yeah, so I just went from undergrad straight out into investment banking. So I started working, I'm a little different. So I have a weird kind of timeline than the traditional investment banking route. I started working with Loan Growth in August of 2019 when I was still in undergrad. And so I've been with them coming up on about 4 years now. So I'm a little different. So I came out and I've already had about a year of experience and I already knew everyone really well. Plus it was 2020, so it was like COVID, which was really weird. So I had a lot of online classes, things like that. So I was just in the office working for that last year. Which I do not recommend. Just finish school and then go work. Don't try to do both. That's a little unnecessary.
Any other questions? Okay, they can contact you. What's the best way to get hold of you? If they're interested.
Email. I'll send out my email tab.
Okay.
And I'll send out this deck and
Yeah,
a sim.
send it to me. I'll forward it on. We'll put it on the Canvas page and then they can get it from there. Great. Thanks, caller.